Good evening. For now, we have our next guest joining us. Rajat Jain is with us, Chief Investment Officer of Principal Mutual Fund. Rajat, good afternoon. Thanks much for joining us. Now, you know,
Thanks for having.
I'm asking you the same question that I asked, my guest yesterday. You're launching a large cap fund, at a time when the flavor of the market is really the mid caps and small caps. Explain the rationale to us.
Okay, well, thanks. Okay, it's not really a tactical launch that we have. No, we believe, and if you look at the total equity investment in mutual funds, large cap is clearly a large category. If you look at the benchmarks, large caps are, for a say benchmark like the BSE 500, would be around 65 to 70% of the benchmark. So clearly, it's an important category. These are well-run companies. We know that. So I think it's a space for all investors to have some exposure to that part. However, what is different in our fund also is we're going to have 15% of the portfolio invested in US large cap companies as well. So not only are you getting exposure to Indian large caps, you also get the opportunity to invest in US large caps as well. So in that sense, which is the first large cap fund in India, which does that. So that's different on this fund. So both we believe Indian large caps have legs. I mean, the rally has been there in the markets. We have seen that. You referred to the rally in the mid and the small caps, there are good companies there, and it's more tactical last week possibly. But large caps have, long-term themes behind them. Globally, of course, so by investing in US large caps, you get exposure to the global technology leaders. You get potentially global healthcare companies, your services companies, financials, and so on and so forth. So you get a decent diversification, both Indian and US large caps in this fund.
Okay, well, that's the really interesting bit, that you get a large cap fund that has exposure to, both geographies, India and the US. Let me ask you a little more on this, Rajat. Right now there's been this overwhelming positivity surrounding US tech. Has that been the motivation? Will you look beyond tech as a sector? Because the last word hasn't been said on it, right? Whether we're going to get a deeper correction or not. So I'm just trying to understand how you'll build on the US theme, because that's the novelty factor of this fund.
Yeah, so while technology is clearly an important piece of the benchmark, even look at the S&P 500, which is a slightly broader based index than the NASDAQ 100, for example. NASDAQ does have exposure to tech. But tech companies, the market caps have grown. These are global companies. They are all cash flow generating companies. They have, gained from the fact that the bigger companies have disproportionately gained in this environment. In the past few years, in the case of technology companies. So while technology will be a part of the portfolio, but it's going to be diversified across, sectors, across healthcare, financials, and others as well. But clearly, tech is an important piece. So it's the motivation, to answer your question, Surabhi, is not only because we see tech, but tech clearly is an important piece of the portfolio, no denying. These companies, one thing's different. If you look at the environment in 2000, when you had this, frenzy in tech, this is slightly different this time around. The tech companies clearly quote at a premium to the broad market, but the extent of the premium is much more moderate compared to what it was in 2000. The return ratios, the ROEs, if you see the way the tech companies have moved and the ROEs of those companies, so actually the performance of the companies has pretty much mirrored in some sense the ROEs that the companies have shown. So the companies are doing very well, the return ratios are improving. The premium is not the way it was in 2000. There is a premium to the market in the case of these tech companies, but it's much more moderate now. And we believe this, there will be certainly, near-term ups and downs. The market certainly could take a correction. There could be events, but we do believe that tech companies and the US market per se should do well over the medium to long term.
Okay, now let's get to your mid-cap fund. And some of these stocks are, of course, now bordering onto large caps, but phenomenal move in some of these pure consumption plays, Tata Consumer and Jubilant FoodWorks. Now, Rajat, these stocks have been, and they've been doing well for last 3-4 years now. But what's driving this kind of valuation re-rating?
Uh, so I think the market has been somewhat polarized, and so you are looking at companies. So what's market rewarding? Market's rewarding companies with moderate leverage, not zero leverage, but companies with moderate leverage, companies which have some predictability in terms of earnings growth, which have at least a medium to long term runway ahead of them. And I won't say cheap, nothing is cheap. In quality, nothing is cheap in the market, but it's fair to reasonable valuation. So many of these companies tick those boxes. I mean, look at, if you just step back and see, I mean, we're also looking at growth, say, in parts of consumer discretionary, for example. You look at air conditioners, for example. Some companies in that space are doing well. I mean, the companies that you mentioned, while I cannot talk about specific companies, but where the market feels that in terms of potential growth that they consolidate. If you look at restaurants, a couple of companies that you spoke about, one of the companies that you spoke about is in the fast food or the QSR category. What you're certainly going to see more consolidations. You'll have the smaller, the mid-sized players, certainly difficult for them to continue. I mean, it will take a while for them to come back. I think these people are going to gain market share. So I think the market's accounting for all of that when the markets give them these sort of multiples.
Okay, we've been having this endless chat around technology, and Rajat, it's expected, right? And now I'm not talking about US tech, I'm talking about India tech. How is your positioning on some of these stocks? I know Infosys, for instance, finds its place as a big holding in some of your funds. But current valuations, this excitement, some will say maybe overexcitement in mid-cap IT. What's your view on it?
Yeah, two pieces to it. I think tech as a category in general, and then mid-cap IT in particular, come to both. So we have been, relatively, I mean, among the fund houses which have been either low underweight in tech or neutral. Actually, now we are overweight in tech, most of our funds. But even earlier, when most of the fund houses in the street had a substantial underweight positions in tech, we never had that in our portfolio. And the reason obviously was, I thought the markets were concerned about the potential slowdown in terms of spend on tech from the BFSI space and so on. But we see, I mean, tech is just a way of, these are essentially service companies, right? So they help companies become much more efficient and so on and so forth. So so these companies always will see some spend coming their way. But in terms of the mid-cap, what's really happened is, unfortunately, if you look at the mid-cap, the way it is defined under SEBI regulation, there are limited number of stocks in that universe, probably I think about 5 or 6 stocks. And the free float available in the case of mid-cap companies compared to what is the size of the mid-cap universe. So not only mid-cap funds invest in mid-cap stocks, larger mid-cap funds do, and multi-cap funds obviously invest in mid-cap stocks as well. And as people wanted to buy tech, there's limited space available, limited companies available in the mid-cap space to buy. So which has led to, I think, so that's more of a technical factor there. I mean, these companies are good companies, no denying that. But there's a technical factor also backing this sharp rally in the mid-cap techs.
Okay, Rajat, we will leave it here today. Thanks a lot for joining us. Just want to focus on the 3 p.m. move on the expiry, and you know what, the Nifty almost broke 11,500. It's once again taken support at that morning low of about 11,500. The bank Nifty has been weak, so that also is down about 250 points. So there also there's some selling pressure. There's some mid caps as well where we're seeing some bit of selling at this point in time. Just look at that. So some bit of selling pressure picking up, Surabhi, on the market.
Yeah, that's right. So it's not very steady. I mean, we know that 11,500 is under threat now. And Anuj, I mean, I go back to the question that I was asking earlier, that yeah, fresh lows now, and let's see if 11,500 can be held or not. Now we are falling in sync with the global weakness. Pull up European markets again. As we've been telling you, Dow futures are still down about 250 points, I think 260 points last I checked. So Anuj, I mean, how should we read this now? Once the expiry factor is over, will only then we get to a decisive answer? How do you look at the volatility around the 3 p.m. move?
Surabhi, it's often said that markets do not necessarily repeat themselves, but you get a lot of good anecdotes. I've been talking about this deja vu feeling about 10th and 11th June move. If you see the last time when we had that Fed meet, the market as usual went into the Fed event with long positions, and next day we had that root shock and the market fell. And that's when across the board we had decline in the market. The market fell for 2 days, 2 or 3 days, I think, and then they found support. And led by the global markets once again, the market moved up, once more. And beyond a point, it's not as if the Fed has announced that they're going to hike rate tomorrow. It's your interpretation whether Fed is hawkish or not. I think it's the same problem that the market had last time. But if this zero rate and QE continues, in that case, the larger texture of buy on dips at some point will be respected. Now, whether that comes in at 11,450, which is the 20-day moving average, or say 11,350 to 400, which has been a support zone for the market, I think that only time will tell. But in the near term, the market needed a reason to correct. It was at intermediate high, it needed a reason, and it's got that. And that's what I would attribute this to. As I said, if I take lesson from what happened after last Fed meet, when the next day market fell and it fell for 2-3 days, but after that, once it took support, it bounced back. So I think that, as of now, perhaps still would be the texture.
Yeah, I guess the market always wants the Goldilocks scenario, right? Accommodative monetary policy and commentary that's weak on the economy, but just enough weak, not very weak. And I guess that's been the debate since last night, whether the Fed is too worried about the economy and whether that's something that the market needs to take note of. It hasn't done that in so many months now. Anyway, that's the picture. We do need to take another quick break. We'll come back on the other side. The conversation continues. But before we get into the break, here's a quick reminder. The National Stock Exchange and cnbc TV 18 have come together to promote investor awareness through a special campaign called Informed Investor that empowers you to make the right decisions with your money. Now, the first thing that we usually check before hiring a driver is whether he has a valid driving license or not. This small check gives us surety that we will not meet any accidents. Similarly, in investing,